Hey guys, Ben Nathan here. Wanted to provide for you a free lesson that would be applicable to what's been going on today. Today's, at the time of recording this video, is the 8th of July at around 12:30 in the afternoon in the UK. Now, we want to go through what's gone on with the New Zealand dollar and also go over why we've seen certain moves. Right, first of all, as we know, the New Zealand dollar has plummeted over the last month. So we're around 600 pips down from where we were. Well, that's how far down we've moved in the markets. Same goes for the pound New Zealand dollar. So it's been rising up against the New Zealand dollar by about 2,200 pips. So the New Zealand dollar has been really weak. Now, fundamentally, data is still weak in the New Zealand dollar. Business confidence is at a several-year low, as well as other bits of data that have come through in the feed. And basically, the markets are now looking to the Royal Bank of New Zealand for further rate cuts. So the New Zealand dollar is in a bit of trouble at the moment. But what have we seen today? Bear in mind, fundamentally, there's nothing at all that's good about the New Zealand dollar. Well, we've rallied up around 90 pips against that strong US dollar. And we've rallied down about 330 pips against that strong pound. So the question is, why has that happened? Why? What's caused this move? Well, it's more likely to be something that's happened from the bigger institutionalized traders, and it's called short covering. And what we're going to do, I'm going to try and simplify the phrase short covering and briefly go through what it is. So, to try and keep things as simple as possible, we're going to imagine that this relates to stocks. Okay, it's related to Forex too. We've seen it today in the New Zealand dollar, and you've seen it yourself in this video. Okay, so what is short covering? Well, let's say you were looking to buy Ben Nathan stocks. Okay, and what we're going to do, we're going to go through price, quantity, and value. Now, first of all, we need to imagine we're looking to sell. Okay, so selling stock, looking for sell orders. So let's say price was at $2 and you were looking to sell 100. So the value of that would be $200. That's the value of that stock at the time. And remember, you're looking to sell it. So let's say a little while later, price drops. And what actually happens is price drops down to the value of $1. So at this point, your 100, the Ben Nathan stock, if you used to buy more, would be priced at $100 for 100 shares. So price is effectively halved. So remember, you sold the stock, you're in a sell order. So the value at market price has decreased. So at that point, there's $100 of profit on the table. Okay, so really what you want to do, you want to hold on to that profit, and that's when short covering comes into play. So, short covering. So what you do at that point, you buy stock at the current market price, and you buy the same amount at $100 for the 100 shares at the value of $100, as I've said. And of course, what you effectively do at that point, effectively, you've banked the profit. Okay, and that is essentially what short covering is. So I've tried to make it as simple as I possibly can. It's not a complicated concept, but it's just easy to show you from stock market points of view as to what short covering actually is. So in effect, it's the act of buying securities to cover profits made from sold security. And that is essentially the active short covering, and that's what we've seen here on the New Zealand dollar. So what's happened is lots and lots of people have brought the New Zealand dollar while it's at an all-time low for a long time to cover their profits. And that's why we've seen the value increase on the New Zealand dollar today.